In our previous discussion, we mentioned the fact that permanent insurance, whole life in particular, as we're talking about now, has what's called a policy reserve. That policy reserve is also known as your cash surrender value. Now, the question really comes down to is that what can I do with my cash surrender value? What are the things that I can do with it? I know that my death benefit, for example, is $500,000. However, I've got, let's say, $50,000 worth of cash sitting in that policy. What can I do with that $50,000 while I'm still alive and everything else? Do I have access to that money? And so on and so forth. So what you're really saying is that how do I actually access this money? Well, the first thing, obviously, is you can cash the policy in. So, for example, if you have a statement from the insurance company that says you've got $50,000 worth of cash sitting in there, and you say, I want to cash out, you simply cash the policy in, they give you $50,000, and that's the end of it. The problem with that, of course, is you've also lapsed your policy. In other words, you have no more coverage. So your $500,000 is now gone, and you have your $50,000 worth of cash. Well, that's not necessarily a good idea. You want to make sure that your client actually gets the face amount of the policy at all times. Okay, so therefore they still want to have access to that money, however, without cashing the policy in. In other words, they don't want to forfeit the policy. So what insurance companies have is what we call non-forfeiture. In other words, how do I get my money out without necessarily forfeiting my policy? The first thing, of course, is you can borrow money. Okay, so in other words, the insurance company will allow you to borrow up to 90% of whatever that policy has. In other words, whatever the cash surrender value of the policy has. So in our example, the $50,000. So it allows you to actually borrow up to 90% of that $50,000. And therefore, again, you've got access to that money. But at the same time, you don't actually forfeit the policy. You're still insured for $500,000. You still continue on paying the premiums and so on and so forth, okay? Except that now you also have access to that money. The second thing is if you don't want to pay any more premiums, you can also do what's called automatic premium loan, APL. And here, what basically happens is the insurance companies goes in and takes out, let's say, $2,000 a year or $100 a month, whatever your premium happens to be, automatically. So basically, all they're saying is you're not paying your premium, Mr. Customer, so therefore we're going to go into your cash surrender, your $5,000 in our example, and we're simply going to take out, let's say, $2,000 a year, every single year, automatically to make sure that the policy will stay in force. So, but again, I stress to you that it is a loan, so therefore, once again, you're going to be charged interest and so on, and if when the person dies, of course, the loan has to be paid back upon death. So it's automatically premium loan. The next one is what we call extended term insurance. So this is for the individual who's basically saying, I need coverage, I need the $500,000 worth of coverage, but I don't want to have to pay any more premiums. I'm not interested in this automatic premium loan part. I really would like to be able to have $500,000 worth of coverage, but I don't want to pay any more premium. Well, what the insurance company will do is it will take the premium that's in there. So in our example, the cash value that's in that policy, that $50,000, it would actually go ahead and buy a single premium, $50,000, to buy term insurance equal to $500,000. Now, because it's term insurance, of course, it has a termination date. So you got to be very careful with this because it may ask you, say, $50,000 will buy you $500,000 of coverage, to say, for 12.5 years. If a client dies within 12.5 years, they'll get the $500,000. If they die the day after, there is no coverage because it is term insurance. Now, for the individual who says, no, I don't want to do that. I don't want this, to have actual termination date. But I do need coverage for the rest of my life. So therefore, I do want some kind of coverage. Then they can buy what's called reduced paid-up insurance. In this case here, it's not going to be $500,000. Once again, they're going to use the $50,000 worth of cash that's sitting in the policy as a single premium. That single premium will now buy permanent insurance, but it will be reduced. In other words, it won't be $500,000. It may drop to $250,000, let's say, but they will be insured for $250,000 for the rest of their lives. So unlike the extended term insurance, which keeps the same amount of insurance, but for a limited period of time, in other words, term insurance, the reduced paid-up insurance basically says you keep the coverage for the rest of your life. However, we're going to reduce the actual amount of coverage for you, but you will be insured for the rest of your life.